Welcome, ladies and gentlemen, to the Cima strategic case study P3, that is risk management, complete essentials revision, segment number 1. This segment is the introduction to risk. Let's take a look. There we go. So within introduction to risk, we try to understand what risk is. Before we get started, I have to give you a few kind suggestions. Please have a notebook and pen on the ready. Follow the slides and my explanation carefully. Make notes as you deem necessary. Maintain a list of key topics that you feel you're weak at so you can self-revise later. And do maintain a list of key performance and management tools that can help model answers in the strategic case study. Obviously, we will be using these tools when we prep for the case study exam, but it would be prudent for you to maintain such a list if at all. Anyway, P3 is an area where we come across so many of such tools that we can use. And very important, quick reminder on the core activities. As you know, you are tested on 5 core activities and your entire P3 syllabus focuses on the last 2. And this is among the 3 subjects, P3, E3 and F3. E3 and P3 are the 2 subjects that you have where 2 dual core activities are tested, and in P3 you're tested on core activity D, evaluate and mitigate risk, under which you get to evaluate and respond to risk, manage the risk register, identify ethical dilemmas and respond accordingly, evaluate and mitigate cyber risks, and you also get to recommend internal controls. In E, which is all about recommending and maintaining a sound control environment, you get to apply internal audit resources, evaluate the implications of compliance failures, and respond to threats of poor governance. There we go. So this is not the most, I would say it's the most critical chapter when you're entering risk management and understanding risk management, but also not a very lengthy one. It's primarily divided into 3 segments. One is what exactly does risk mean. The second is the categorization of risk, and third, predominantly trying to understand why would a business undertake risk. So first, what exactly is risk? Let's try to understand the definition. Now there are many definitions. Like for example, Cima official terminology defines risk to be a condition in which there exists a quantifiable dispersion in the possible outcomes from any activity. And the risk can be defined according to the ISO Guide 73 as the combination of the probability of an event and its consequences. So there are different definitions, but practically if you try to just give a basic idea, and if you try to simplify it and understand it practically, we would say that risk in business is the chance that future events or results may not be as expected. Risk is often thought of as purely bad, which we normally note as downside risk or pure risk, but risk can also be good. That is, the results may be better than expected, which we say speculative or upside risk, while it could also go from bad to worse. Now, when you deal with risk, you have to try and understand that there is an element called uncertainty, and the difference between risk and uncertainty can be very, very subtle. So what is risk and what is uncertainty, right? If someone asks you that, you have to have a fair understanding of what the distinctive difference means. Now, risk is inherent in a situation whenever an outcome is not inevitable. So basically you're looking at a situation where the outcome is known, and on top of the known factor, we say that risk is quantifiable, whereas uncertainty, by contrast, arises from ignorance and a lack of information, basically non-quantifiable. So like for example, you would have seen when you're watching football matches, there are predictions as to this team has a 50% chance of winning, or 40% chance, or 80% chance of winning. This is based on previous behavior. It is based on past results and past behavior that have been quantified. But if you look at something like nowadays, something very elusive in terms of predictions is the climate. You know how it's very difficult to predict the weather these days, because climate change is a massive thing, and there is always uncertainty. 20 years ago, weather predictions were spot on. They say it's going to rain at 4 o'clock, it's probably going to rain at 4:15 or whatever. But nowadays, that's not the case. So there we have that difference between what exactly risk and what exactly does uncertainty mean. Second question is, why would a business incur risk? Now, this has simple but very effective answers. There are two main reasons. One is a business could incur risk to gain competitive advantage, while you're also looking at incurring risk to increase financial return. By the time Harry Markowitz introduced portfolio theory back in 1952, every time risk started to become mentioned, return also started to become parallelly mentioned. So risk and return have now become very close companions. Firms must be willing to take risks. To generate higher returns, a business may have to take more risks in order to be competitive. And conversely, not accepting risk tends to make a business less dynamic and implies a follow the leader strategy. So that's why you see that a lot of industry leaders are those who have taken risk, right? Those who have had the courage to take certain decisions that nobody else at the time would have taken. Incurring risk also implies that the returns from different activities will be higher. That is, the benefit being the return for accepting the risk, which is what has led to that famous term or the famous phrase that is hugely popular. If you remember, higher the risk, higher the return. There we go. Benefits can be financial, or in terms of financial, a good example is the decreased costs, whereas benefits could also be intangible, like better quality information. In both cases, these will lead to the business being able to gain competitive advantage. Right. Now, Cima has offered a summary on risk management framework. Risk management is to be a proactive process that is an integral part of strategic management. So within strategic management of the company, you have risk management embedded. And this is the summary by Cima, which is in the Chartered Institute of Management Accountants Risk Management Good Practice Guide, which was published in 2002, which is still appearing in most modern texts related to Cima. And if you look at this, there is a hexagon, and that is the key hexagon that you need to be following. Identify risk areas, understand and assess the scale of risk, development of risk response strategy, implement and allocate, implementation and monitoring of controls, review and refine the process, and basically follow through this cycle repetitively. Just continuously do this. Now, in every stage, you are able to collect information for decision making, and the better the information is, better your decision making is. And you understand that this whole thing, this entire cycle, this entire hexagon is embedded largely within your business strategy. And you establish risk management group and set goals as the primary team. We will look at the risk management group in probably segment number 2. What they exactly have to do, and they are the ones primarily who carry this process. They are the ones who undertake and continuously follow through this process. All right, so the third and the final segment or final part of this segment is the identification and the categorizing of risk. So to analyze risk, this entire chapter, in this entire syllabus, we do a very close analysis of risk. Now, to analyze risk, the best way, one of the best ways that Cima proposes is to categorically look at them. There are so many categories. Now, many organizations categorize risks into different types. The use of risk categories can help with the process of risk identification and assessment. So there is really no single system, and the risk categories used by companies and other organizations differ according to the situations and the circumstances. So there can be very unique risk categories for very unique businesses. Keep that in mind. Now, a few examples, as you can see here, for categories of risk are international risk, fraud and employee malfeasance risk, corporate reputation risk, environmental risk. On the other end, you have political, legal and regulatory risks, business risk, economic risk, financial risk, technology risk, which is a modern one, but nowadays becoming very important and a very big deal. So these are just a few examples of categorizations. You can have your own categorization. There is no problem at all. These just a few suggestions by Cima of how you can categorize risk. So let's take a look at a few examples of these large broader risk categories, and within each of them you will notice that there are sub categories. For example, under political, legal and regulatory, political risk is the risk due to political instability, and it's generally considered to be external to the business, therefore non-controllable also. Legal and litigation risk, that is the risk that legal action will be brought against the business. Then you have regulatory risk, that is the risk of changes in regulating or regulations affecting the business. Compliance risk, that is the risk of non-compliance with the law resulting in fines, penalties, etc. The second broad category we can look at is business risk, kind of like strategic risk. There we go. So strategic risk is the risk that business strategies could fail. Whatever strategy you have implemented, like for example, if you take Kodak or Nokia, fundamentally the risk that they were exposed to when they fell, when those giants fell, was their exposure to strategic risk. Product risk, risk of failure of new product launches or loss of interest in existing products. Commodity price risk, risk of a rise in commodity prices. Product reputation risk, that is the risk of change in product's reputation or image. Operational risk, that is the risk that business operations may be inefficient or business processes may fail. Contractual inadequacy risk, that is the risk that the terms of a contract do not fully cover a business against all potential outcomes, and this can be very severe in the case you want to pull out of a joint venture and you really haven't covered all bases. It can be a serious matter. Then you have employee malfeasance risk. So malfeasance means doing wrong or committing an offense. Now it's a little different to fraud. Organizations might be exposed to risks of actions by employees that result in an offense or crime other than fraud. So this, like fraud risk, is a type of operational business risk. So we will look at fraud risk also separately. Then you have economic risk. This is the risk that changes in the economy might affect the business. These changes could be inflation, unemployment rates, international trade relations, or the fiscal policy decisions by the government. And again, it's considered to be external to the business, while also noting that it can be very highly non-controllable. So one good example is the 2008 global financial crisis, which was basically due to the subprime mortgage crisis, right? Where all these big banks issued collateralized debt obligations, where they bundled up triple C or poorly rated debt with a few sprinkled AAA rated bonds on the top, and packaging it and selling it as if they are AAA rated, which is a major, even in terms of risk ratings, right, which is a major concern, because most of these risk rating or credit rating agencies also didn't catch. So their analysis also had particular shortfalls. Then you have financial risk. Financial risk is the risk of a change in a financial condition, such as an exchange rate, interest rate, or the credit rating of a customer, or even a price of a good. Credit risk, that is risk of non-payment by customers. Political risk, in within financial risk is the risk arising from actions taken by a government that affect the financial aspects of the business. Currency risk and interest rate risk. These are risks of fluctuations in the exchange rate or the interest rates. LIBOR changes there is going to be impact to other economies, etc., etc. So you're always exposed to some sort of currency and interest rate risk. You know, in financial strategy, there are 3-4 chapters completely dedicated to the idea of dealing with these fluctuations. Gearing risk. Risk in the way a business is financed, that is the capital mix of your company, the capital structure, and you're always in a struggle to find the optimal capital structure, aren't you? Right. Then we can look at technology risk, very important in the modern day and age especially. Technology risk is the risk that technology changes will occur that either present new opportunities to businesses or on the downside make their existing processes obsolete or inefficient. So most of the disruptive technologies, machine intelligence, that is AI, artificial intelligence, machine learning algorithms, process automation, 3D printing, right? Most of these digital technologies that you learn in E3 are disruptive and have created technology risk on a downside perspective. Another element under technology risk, which is by and large a very critical aspect nowadays, is cyber risk. So cyber risk is a focus area for organizations now. It is the risk of financial loss, disruption or damage to an organization caused by issues with the information technology systems that they use. Environmental risk. So environmental risk is the risk that arises from changes in the environment like climate change or natural disasters. Some businesses may perceive this risk to be low, but for others, for example, like insurance companies, can be very significant. Insurance companies have to take environmental risks into account when deciding policy premiums, and unusual environmental circumstances can severely alter the results of insurance businesses, just as an example. And I would say that environmental risk every single day on a daily basis is drastically increasing. Then you have fraud risk. Fraud risk, which is a type of a subclass of operational business risk, is the vulnerability of an organization to fraud. So we have a separate segment also dedicated to this aspect of risk. Some businesses are more vulnerable than others to fraud, and as a result have to have stronger controls over fraud. Fraud risk is a risk that is considered controllable by most businesses. Corporate reputation risk. So reputation risk is for many organizations a downside risk, as the better the reputation of the business, the more risk there is of losing it. A good reputation can be very quickly eroded if companies suffer adverse media comments, which is why you try to manage your PR aspect, public relations aspect of things as best as you can. And on the other end, if you're perceived to be untrustworthy, right? If your customers label you as untrustworthy, your reputation is down the drain, and then it's very difficult to retain your position in the market. So reputation risk is a very critical aspect. In fact, there is a separate segment completely dedicated on reputation risk because of the level of importance we give to it. Then you understand that most of the companies we use, we get presented in the case study exam especially, are multinational or sometimes even transnational. In that case, there are risks in international operations and business. Culture, right, under which we are going to look at some elements. Culture. A local business could fail in a venture overseas because it does not adapt to the overseas culture. Litigation. That is, there is greater litigation risk in overseas operations, as the parent company management may not understand the legislation really well and are therefore more at a risk of breaching it. Credit. There is often a greater difficulty in controlling credit risk in overseas sales. Chasing debt is more difficult and expensive. Items in transit. There is a greater risk of losses or damage in transit if companies are transporting goods great, large, long distances. Financial risks. These are similar to the financial risks we discussed, but with an international exposure. So Quick summary, as I said, it's not the lengthiest, but it is a very important one because we just understood what exactly risk means, why businesses, because there is this negative element to it when we understand it, but we also realize that businesses take risk. When we ask why, we have two answers: for competitive advantage and to increase return. So higher the risk, higher the return. And to classify and analyze risk, the best way is to categorize it. And we understood almost all the types of general risk categories we face, especially in the strategic case study exam. That marks the end of segment 1. So as I always say, do keep learning and enjoy the process. Thank you very much for joining the segment and tuning in. I hope you learnt what risk means. This will be a good entry to the rest of the segments as you watch them and understand risk management overall. On that note, happy learning and thank you very much. I will see you soon.